What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we start off the month and the week with a big move, especially in the stock market. The S&P 500 was up 2.38% today, which is the biggest single update that it's had since June of last year. Now, the story in the media, the mainstream financial news is it's more of the same, right? Stimulus talks, vaccine rollouts, economy opening back up. And so what we're going to do is look at how asset prices right now are moving in response or in anticipation, really, of what is about to come. Ready? Let's dive in. All right, guys, so like I said, the stock market, specifically the S&P 500 today, was up 2.38% at the close, which is its biggest update that the market has had since June. So as far as stocks go, it looks like the melt up is in full effect here. We had a sell-off over the last couple of days of last week that has almost fully been erased by now across most stocks in the market. Now, if we look specifically at the Russell 2000, this is one area where we can see that asset prices, have been completely kind of divorced from economic reality. If you look at the trailing 12 months earnings per share versus the price of the Russell 2000, you can see the absolute insane discrepancy that we're seeing right now between asset prices and the value that they're actually worth. This is a traditional fundamental valuation metric, and you can see here this chart by Crescat Capital, utterly divorced from reality, these asset prices, and really with small stocks in the United States, that is showing up in a particularly extreme fashion. But given the monetary policy, the monetary lunacy that the entire world is looking at right now, you can't really argue with somebody who says, do I want to hold dollars or do I want to hold stocks? Because the only thing dollars have done since we divorced from the gold standard is go down. They've lost 94-95% of their purchasing power since then. Well, stocks, they stick around. They might crash, they might stall out, you might go through periods of time where they don't grow, and stocks can go bankrupt, right? So they can go to zero, but ultimately, as long as you hold a basket of stocks, you still own equity in a lot of companies. They're not all going to go bankrupt, and over time, they'll figure out ways to make money again, right? So even if you do have a crash, eventually you still own equity in a company that's still looking for ways to be profitable. So for the average investor, can you really blame somebody who says, hey, well, I can invest in these stocks at these insane valuations, or I can hold dollars, which arguably dollars have the most insane valuation there is right now? You can make a good argument that there's nothing going for the dollar. Now that brings us to Bitcoin, because a lot of people say the same thing about Bitcoin, and recently in the price action here with Bitcoin, we can see that it held up at its new support level of 44,000. We've had a couple touches there as soon as it broke through. We had a retest, and now a couple of times since that first time we broke through 44,000, we've retested and held support. Now it looks like we're consolidating between 44,000 and somewhere under 50,000 here. That range is where most of the trading volume has been since we broke above 44, and so we'll see. We'll probably continue to move sideways in this channel until we build enough pressure one way or another. Not sure whether the breakout is going to be to the downside or to the upside. I still have a price target for Bitcoin by the end of the year to hit 200 to 250,000 based on the stock to flow model, and a subsequent crash after that, 60, 80, 90% wouldn't surprise me. As of right now, I'm still stacking sats. I like to use Swan Bitcoin. They're hyper focused on security. They only do Bitcoin as opposed to all cryptocurrencies, which I really like. And they make it really easy to dollar cost average or purchase small amounts on regular intervals, like every day or every week or every month. And if you sign up using my link in the description below, you can get $10 worth of Bitcoin free for signing up. Now, kind of a mirror image to the fantastic price action we've seen over the last couple of months from Bitcoin is gold. And gold, again, today did not pop back up after its down day on Friday when it kind of broke support and fell down. And so we, kind of stayed in the same range. It was down just a tad bit today. Miners were down a little bit more, and then silver was up slightly, but again, not much. And so precious metals are still getting hammered here. And the short-term silver lining, if you will, on this price action with gold and silver is that things look very oversold right now from a technical standpoint. When you look at the price action, it looks like everything is oversold right now. So we're due for a little bit of a pop, a little bit of a reprieve in this short-term sell-off that we've seen over the last couple of weeks. Now, I don't know if that will be enough to break us out of this long-term 6-7 month correction bear market that we've seen, especially in gold, but we shall see. And the main thing driving gold right now is going to be interest rates. So let's move on to bonds here. We've seen a massive steepening in the yield curve, which I've been talking about heavily for the last couple of weeks, because this is one of the biggest things driving markets right now, is that people are selling bonds. Why are people selling bonds? Because inflation expectations are going up, because the government is spending money that it doesn't have. The Federal Reserve is the one that is funding that. So the Federal Reserve prints money. They push those reserves into banks. The banks use those reserves to basically lend to the government. And so, yes, it's indirect, and I know that there are nuances in that description. It's the overall effect that matters, not the nuances of the mechanics in the system. Essentially, the Federal Reserve is enabling the government to spend as much money as they want. And with all this new money going into the economy, especially now in the next couple of weeks, as it looks like there's going to be a new round of stimulus checks sent out to individuals, you've got more money chasing the same amount of stuff. That's going to push prices up, especially considering that there are actually downward pressures on supplies of things, just like commodities and raw materials. Even without the added pressure of additional dollars chasing those same things, there's less things to be chased right now. So because of all these inflation concerns, people are selling bonds, because you don't want to get paid 1 or 2% on your bond if you think inflation is going to be 3, 4, 5, 6%. You're going to sell that bond. The only way you'll lend again or buy the bond, because that's the same thing, is if you could get at least the same as what you expect inflation to be. If you expect inflation to be 5%, you'll lend money at 5% or more in order to not lose purchasing power. So you're going to sell a bond and wait till rates get there. And so rates are popping, especially the longer term rates like the 30-year treasury. And so we've seen a big steepening in the yield curve. This is problematic because we don't know where the line in the sand is, but at some point the government and the overall economy can't afford to continue rolling over its debt. We are very over leveraged. The only way that corporate America and the government is paying off its old debt is by taking a new loan to pay off the old debt and fund its new expenses. This means that if interest rates go up and you have to borrow at a higher interest rate, you can't afford it. You're insolvent. So at some point here, and we're probably getting pretty close, the Federal Reserve is going to have to step in and say, hey, we're going to be buying more bonds now because you guys are all selling them. Nobody else in the market is buying them enough to keep rates where we want them. So we're going to have to start buying bonds that are further out on the yield curve, the longer maturity bonds. We're going to have to start buying those to push those rates back down. Once that happens, that's rocket fuel for gold and other assets as well, because that's real yields getting pushed down as well. Right now, yields have been rising. When yields are rising, that's a headwind for gold. That's hard for gold to perform well, especially in the short term when real yields are rising, which they have been. Inflation has been going up, so interest rates have been responding. But as soon as the Fed steps in and pushes those interest rates back down, that sends gold flying. And so that's going to be the big indicator that the gold bottom is in, is when the Federal Reserve steps up their bond buying purchases and you see the long end of the yield curve pushed back down. Now, finally, a quick note on real estate. We know that mortgage rates have been increasing steadily for the last couple of weeks here. You can see here that 30-year fixed rate mortgages bottomed out at about 2.6%, and the last reading they were up at 2.97%. Now, this is another area that will get shoved back down because this is directly, this is a market that the Federal Reserve directly interferes in, not indirectly. They actually buy mortgage-backed securities to hold on their balance sheet. It's just mortgage-backed securities and treasuries that they're allowed to hold on their balance sheet. Everything else that they buy, like corporate debt, that's held in separate vehicles on other balance sheets with those special purpose vehicles that are held at the Treasury. So this is another area those rates will probably come back down at some point. We might see them move up before they go back down, but they're going to have to get pushed down again, especially as the Fed continues to increase their debt purchases, expanding their balance sheet more as this year progresses. But even if mortgage rates don't get pushed back down and they do keep on going up, I do not anticipate this to have a significant negative effect on real estate whatsoever. Inventory in the nation average, the nationwide, I'm not talking, obviously you can find exceptions in specific local pockets, but on average, inventory overall nationwide is at a point where it can't be fixed for at least a couple of years, more likely 5 to 10 years, if it's worked on in the appropriate way. And that's the number one driving factor of real estate, especially right now, is going to be inventory. There's just not enough places for people to live when you compare it to the actual number of people that want a place to live. And interest rates going up 0.5%, 1%, 2% more from where they're at right now, it's not going to make an impact on inventory. And so the growth rate might be slowed, but it'll still be growing. Add on top of that the fact that we're very likely at some point this year to get a $15,000 first-time home buyer tax credit that can be applied as a down payment. So this will flood the real estate market with even more buyers, causing an even higher mismatch or imbalance between buyers and sellers than we have right now. Now, especially since the House last week passed the stimulus bill and it's moved on to the Senate now, and it looks like at this point the only thing that's going to get cut out is the $15 minimum wage. It looks very likely that the market's response to the potential stimulus package that's about to get passed in the next couple of weeks is proper, considering the amount of money that is about to hit the system. As always, I really appreciate you guys watching. Thanks so much. Have a good day.